The property that we decided to research for a possible investment is a multifamily home located in the Columbia City neighborhood of Seattle. The address is 5931 Martin Luther King Jr. Way South, Seattle, Washington 98115. The property is specifically considered a triplex and consists of 3 separate units with room for 3 separate tenants. 2 of the units contain 1 bedroom and 1 bathroom, totaling 540 square feet. The last unit contains 2 bedrooms and 1 bathroom, totaling 700 square feet. The building totals 1,780 square feet and rests on a 4,228 square foot lot. The structure was built in 1953, and the exterior is a combination of brick and wood. The triplex is sewer connected with baseboard heating and cooling, and electricity serving as the main energy source. This property is located with near access to the Sound Transit light rail and all the amenities of Columbia City. The units are clean and occupied by long-term tenants. Tenants pay month to month, and rent rates have never been raised and are well below market rates and the rates of comparable properties. The asking price for this triplex is listed at $325,000.
Property type analysis. To help evaluate this property investment, we employed 4 comparable properties from the surrounding area. We felt that these properties were very comparable to our property in question based on age of the building, building size, and lot size. These properties were also all sold in the past 4 months, further adding to the similarity to investment we have been analyzing. After looking at these sales comps, we concluded that the investment on 5931 Martin Luther King Jr. Way South is a little bit overpriced. The comps had an average price per square foot of $149.75, and the average for the Rainier Valley market is about $122.70, which is learned from a property report by Dupree and Scott from April 2014. The property we have been looking at is priced at $182.58 per square foot, which is well above these 2 averages. We also use these comparables to analyze rent levels. We found that the average rent per square foot for these 4 properties was about 96 cents per square foot. This property currently is renting at about 86 cents per square foot, which is clearly below the standards of the comparables. We believe that this discrepancy between the rent of this property and the comparables comes from the previous owner's practice of never raising rents. This means that there is a potential for rent growth associated with this property. Forecasting towards the future, we used more research from Dupree and Scott. Their report predicts that vacancy rates will be about 2.8% for 1-bedroom apartments and about 4.2% for 2-bedroom apartments in the Columbia City neighborhood. 42% of the residents in this area are rents, giving us reason to believe that finding tenants for this property should not be a problem if tenants are needed in the future. In addition, there is a predicted 15% growth in jobs over the next 5 years and are attracted for more potential tenants. Cash flow assumptions. There are many cash flow assumptions to be made when looking at this property. First, the lease will be a triple net lease, as is a standard in the industry. The annual rent adjustment in the Rainier Valley is 4%, but our property is a little older, so we dropped the growth rate to 3% in the years after year 1. In year 1, we grew rents 50% as our current rents are well below market average rents because the previous owner didn't raise rents on long-term tenants. We assumed a vacancy rate of 5% after looking over our comparable properties and subject property. For leasing commissions, we found the average PGI and multiplied by an estimated 1.5 turnover in 5 years, multiplied by a 3% leasing commission divided by the number of years. We didn't allocate it evenly across the time period because we do not know exactly when a tenant will vacate. We went with the higher rate of the common sales commissions of 3%, and we assumed the sale price to be $458,398 after dividing year 6 NOI by the exit cap of 5%. Risks and reward. As with any investment, and particularly real estate investments, there is a considerable amount of risk associated with this project. This property isn't located in one of the most desirable trending neighborhoods, which may make attracting tenants in the volatile real estate market difficult if new tenants are needed. The building is also in fair condition, and although it does not require any repairs or capital improvements at this point, it is possible that it may require either of those sometime in the future. The multiple tenants of this building also pose as a source of risk for an investor. Aside from the possibility of not being able to make payments, the relationships between tenants can be risky in the sense of stress placed on the investor if tenants do not get along or interact well together. As we know, the real estate market is rather unpredictable, so this risk must be considered. This triplex has already been on the market for about a year, which is a red flag for the property and market itself. There is also the risk of a market downturn after the purchase of the property and a loss of value, making the property a less wise investment than previously expected by the buyer. Focusing more on the fact that the triplex has already been on the market for a year, this property is exposed to liquidity risk. An investor could potentially be stuck holding on to this property in a time they need cash and may not be able to sell off this asset. As for rewards associated with this investment, the return from this property is associated with its ability to generate future cash flows. This triplex is not an enormous upfront investment, which could benefit an investor in realizing positive return more quickly than in a more expensive investment. The vacancy rate of this property is also low, and the triplex already has 3 existing tenants occupying its 3 units. This eliminates the need to search for tenants immediately upon an acquisition, and the rental rates of this property offer substantial room for growth, bringing in increasing rents and cash flows over the lifetime of the investment. Sensitivity analysis. Vacancy rate. We are increasing rents a huge amount in the first month, so there may be some changes to the vacancy rate. The best case scenario is that the tenants stay or they leave and new tenants come knocking with our rents a little below market average, and account for a 3.2 vacancy rate based off Dupree and Scott's report for the market. This gives an after-tax IRR of 21.2%. Worst case scenario is that we can't find tenants for 3 months and have a 25% vacancy rate in year 1, and we struggle to fill the property going forward, so our going out of vacancy rate is 8%. That leaves us with an after-tax IRR of 14.9%. Looking at our new higher rents comparable to our rent comps, we think that we won't have too much trouble finding tenants, but stayed with a conservative 5% vacancy rate in each year. That gave us an after-tax IRR of 18.9%. Purchase price. Under the current purchase price, we are not able to make our mortgage payments for the first 3 years. Being that the home is appraised at $255,000, we aimed to find a price somewhere in between that would give us a positive after-tax NPV in all years. If able to negotiate the price down to $294,500, we would be able to meet all of our mortgage payments without charging loan terms. This is not guaranteed and certainly optimistic. However, the property has been on the market for over a year, thus we are confident that we have some leverage in price negotiation. Recommendation. There are several positive aspects of our Columbia City triplex property. First of all, it is located near the Sound Transit light rail, which is attractive to renters as it provides easy transportation and access to the Puget Sound area. Secondly, while the household median income of the surrounding area is relatively low at $48,251, it is within walking distance of a growing historic Columbia City downtown area. Also, market vacancy rates are low, meaning that it shouldn't be difficult to maintain full occupancy at most times. The current owner has not raised rents in years, and thus current rents are significantly below market rate. This will allow us to immediately increase rents and hopefully increase cash flows. However, it is not as advantageous as having historically high rents. Furthermore, there are other negative aspects of this property. If purchased at the listing price of $325,000, using our current loan terms, we cannot make our mortgage payments for at least the first 3 years. The real estate market is volatile, thus predictions are simply best guesses. Although the rent increases still keep our rates below market average, it is possible that some tenants will be upset and seek out cheaper options elsewhere in the neighborhood. As with any multifamily housing project, some drama may ensue. Having carefully reviewed all relevant financial information and assumptions, we will not move forward with this deal because it is not feasible at the current listing price. Due to the unpredictability of the tenants as well as the risk of asymmetric information, we believe it would be more beneficial to invest our wealth in a less risky instrument and seek a slightly lower return.